Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined once again with my good friend, Doug Hagren. Hey, Doug.
Happy Friday, Kirk. Good to see you again.
Happy Friday. Yeah, I'm excited. My kids are back to school this week. I know everyone else's kids went back before this week, but mine went back this week on Labor Day, which is still weird to me that we had to go on Labor Day. But he's having a good time so far, and I'm happy that he's happy. And I think we're all going back to the new routine. So, but as we kind of dive right in on this fresh fall Friday, lots of new stuff going on, and I want to get into some of it. But one thing I wanted to discuss before we get into the news, actually, it's part of the news, is I've been seeing a lot again. This started a few years ago, and we're seeing it again now. Is the inverted yield curve? Now, a few years ago, I think it was 2022, the yield curve inverted, and when that happened, I'm going to share. Let's see, share this with y'all. Y'all, I can't believe I said y'all.
Yeah,
All right.
and Kirk, I'm posting another one too, if that might also be a decent, decent reference point for you.
All right.
I'll put it in there right now.
So here we go. So here is the yield curve, and this is the 2 and 10 yield curve. Basically, what that means is they're taking the 2-year Treasury and the 10-year Treasury, and normally the 10-year Treasury should be higher, should have a higher yield than the 2-year, because typically what will happen is the shorter the time frame, the lower the yield. The longer the time frame, the higher the yield. That is a normal yield curve. Now, occasionally, the yield curve will invert. And what that means is that the 2-year yield is higher than the 10-year. Now, if you understand why this is the case, and those of you, I'm going to already put people to sleep because people don't like talking about bonds, but the reason that the short end tends to be lower than the long end is because you're getting paid for taking more risk. If I buy a 1-year bond at, let's say, 5%, I think right now it's right around there. It's 5.25%, I think, but let's say it's 5%. Then I expect then in the next year I'll get 5%. Now, if I'm buying a 30-year bond for 5%, I would say, why would I ever buy a 30-year bond? Because I can buy a 1-year for the same rate. So it doesn't make sense to buy a 30-year. Now, let's say the 30-year is at 4%. I don't know what it is now. I think it was actually like 4 and change, but let's say it's at 4%. And the 1-year is at 5%. Why would you ever buy a 30-year? Doesn't make any sense. Why would you ever take a lesser rate and take more risk at the same time? So there's reasons why the yield curve is not typically inverted. And that's the main reason, because financially it doesn't make sense for that to happen. Now, occasionally it does happen. And what will typically happen is, and I'll tell you about the recent example, because going back in history, it's going to take me a while to, get the cobwebs out for why each time happened. But for this recent time, the reason it happened is because we had a very low and flat yield curve for long periods of time. And what happened was the Fed said, you know what, we're going to start raising rates because inflation's here. We need to squash inflation. So they raised rates rapidly throughout 2020. Bond market crashed. The stock market went down. And I think long-term treasuries dropped like 50% or 55% or some crazy number. So if you own long-term bonds, you lost a lot of money. And banks, a lot of them own long-term bonds. So if you look at 2020, it inverted. And basically what happens, the Fed said, all right, we've got this yield curve that's more or less flat. I'm going to start raising the short end, or because that's what they have control over. The Fed has control over the Fed funds rate, which controls the short end. They don't control the long end. Indirectly, they do, but it's mainly the short end they control. They said, we're going to boost this at the short end. So they boosted it all the way up to 5.5%, like 5.25%, 5.5%. And they boosted up, but the long end still stayed low, which means the short end is higher than the long end, which means it incentivizes people to buy the short end, which is what happened. I mean, we were doing that. We were buying the short end because why wouldn't you want 5.25%, 5.5%? It's a great yield. At one point, the long end in the 10-year went out to 5%. I think it hit 5% and then went down. But effectively, you had a period of time where the long end was shorter than the short end. And so when it's inverted, like you see in this chart, that means the short end is higher than the long end. Now, I'm explaining this so I can explain the important piece. The important piece is if you look back in history, what you'll notice on this chart is that every time the yield curve inverts, it leads to a recession. Now, the gray vertical bars are recessions. So every single time, if you go back in history, the correlation is every single time an inverted yield curve happens leads to a recession. Now, let's break apart what I just said. Every time an inverted yield curve happens leads to recession. That is what everyone out there in the corporate media and all the financial professionals on Wall Street, that's what everyone's saying. Inverted yield curves leads to a recession. That is not the truth. The truth is inverted yield curves correlate to recessions. They don't lead to recessions. They lead in the sense that they happen first, but they don't lead to a recession. Now, let's talk this through. So there's two parts to this. One is when an inverted yield curve happens, a recession follows. Let me point out another piece that no one is talking about, but this show right here, is that it's not when you get an inverted yield curve, it's when it reverts back to normal. So what you'll notice, and it doesn't have the early 80s, unfortunately, but what you'll notice is when it inverts, it quickly comes back within a relatively short period, right? It happened in the late 80s. It happened in 2000. It happened in right before 2008. And it happened really briefly before 2020. So what you'll notice is recessions happened somewhere between 12 and 18 months after it inverts. Now, here's the thing to note. After it inverts. Well, because it inverts and comes back so quickly, you can't discern whether it happened after it inverted or after it came back to normal. And the reason I say that is because every single time people said, well, you know, it's a perfect indicator. Every time it happens, it leads to recession. That's true. But my thesis was after it gets back to a normal yield curve, so after it reverts to normal, after that period, you have a recession. Because people have been asking, well, it inverted. Why haven't we had a recession? Does that mean it didn't work? Maybe, because it's a correlation, not a causation. My thesis was it's when it gets back to a normal yield curve, after that is when you get a recession. And the reason being is, if you look at what happened to the Fed basically raised interest rates a lot higher than the market deemed necessary because the short term was at 5.25 to 5.5, and the long end was below 5. So effectively, the long end said, yeah, this is a short-term thing. It's going to change. And they raised rates and they squashed inflation at the moment. I do believe that inflation is not going to come back like people think. It may come back a little, but not the way people think. So they're lowering rates now, which has caused it, as of, I think in the last week, the yield curve to revert to normal, which means that long end and the short end, the 2-year and the 10-year, are now in a normal ratio or normal-ish, right? It just went back to normal. So it's still really kind of the same. But what will happen is, and here's the reason that I think nobody says the reason, because you don't know, right? It's a correlation, not a causation, although people think it's a causation. If it's a causation, I've never heard a legitimate reason why it happens. If I had to guess, the reason why it happens is if you look at banks, and banks lend and then they borrow, right? So they borrow from depositors and they lend out to borrowers, right? So you put $100,000 in your checking account. The bank will take that 100,000 and lend it out to Doug, and Doug will take that. Yes, because Doug needs 100,000. So hypothetical Doug, and so what they'll do is they'll take the money and they'll give 2% to me because I put money in the bank to deposit. They'll give me 2% and they'll lend it to Doug at 5, and they'll make 3% on the spread on that difference. That's how banks make money traditionally, right? That's a traditional commercial bank. That's their retail bank that's lending to consumers. Now, what if the bank has to give me 5% and they can only loan it out at 4%? What's going to happen? The bank is not going to lend out money because they're basically signing up to lose money on the deal. It's kind of like the old adage of, the banks are losing money, so they're going to try to make it up on volume. It's just a bad business model, right? You lose money, so if you do more, you're somehow going to make money. No, that's not what happens. So when the banks are basically losing money on that deal, they're not going to loan and they're not going to lend it out, which is why a lot of banks aren't lending, but the ones that are actually giving depositors like 20 basis points. So we've said this on the show before, so I hope everybody's taken it to heart and done it. But if you were getting 20 basis points on your money on deposits, go to a new bank. Find a bank that's giving you 5%, right? You can get 5.5%, or not now, but you can get at 5% and change on Treasurys. So why would you put money in a bank for like 25 basis points? Doesn't make any sense. The reason that is because banks had to keep it there in order to lend out. If they lent it out, if they gave you 5% and they lent it out at 4%, they would lose money. So that is why a lot of banks were not giving higher rates, is because they had lent out a lot of money at a higher rate or at a lower rate, so they would have basically gone bankrupt. So that's a big reason why all this stuff is happening. Now, so an inverted yield curve means banks don't lend. So that's why historically, in my opinion, this is my thesis, I don't know for sure, but it's the only thing that makes sense. Historically, that's why when you have an inverted yield curve, the banks stop lending. If they stop lending, they stop printing money, because money is traditionally made from banks lending, not from the Fed printing. So historically, going back decades, that is how money was made. And so when you stop making money through lending, it would slow the economy because fewer dollars are put into the system. So it slowed the economy, thus leading to recession. It was all correlated. Whether it's a chicken or an egg, I'm not going to debate that today. I'm just saying they're all correlated, and that's the most logical thesis I could come up with that actually makes sense. Now, since the 2000s, since basically the Fed started creating QE and printing money through QE, the banks stopped lending as much, and money was not being created through banks as much. So it was basically determined on the Fed to create money and through QE. Now, what that means is this inverted yield curve theory might no longer be true. And if my thesis holds that that's why the inverted yield curve led a recession, is because of that mechanism. But because the Fed is now commanding the financial system through QE and other methods, then the inverted yield curve might no longer function as an indicator. Now, I'm still curious to see if my thesis holds that once it reverts back to normal, that will lead a recession. And a lot of people have been predicting a recession in the near future for the last few years, and we haven't had one, except for 2020, which Biden decided it wasn't a recession. But even if it was, it would have been a quick one because the economy was still relatively strong. But now it seems like indicators, and Doug's going to talk about this in a minute, a lot of indicators, especially one that came out today, lead to the fact that we are starting to see economic signs that a recession is ahead of us. Now, I don't know if it'll happen. I don't know when it'll happen. I don't know if it'll happen. But I do know that the signs show that we're leading into a recession. Now, that means lower rates. That means the yield curve should go back to normal. And if we have a recession, then the indicator will no longer be marred by failure. It will actually still have its perfect record. And so I wanted to explain this because I've been seeing a lot in the news. I've been seeing a lot of smart people parrot this, and it's just untrue. It is not a causation. It's a correlation. Just because it's had 100% correlation in the past does not mean it's going to happen in the future. And it also doesn't mean that just because it didn't work, in 2020 that it still won't work because there's a metric in there which I think means that when it reverts back is the indicator. This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today. Anyway, all that being said, we've dissected this. We've gone through it with a fine-tooth comb. I probably put a lot of people to sleep. But what are your thoughts, Doug? What do you think of this inevitable chart crime that people are parroting out there?
Well, actually, one of the things I think about that chart crime is one of the groups that we've actually parroted many times as one of the greater pushers of those chart crimes in that area, I think is actually stated more in line with what you just said for once. And again, when we talk about this inversion, being, is it causation, is it correlated, or is it causation on this? I think, Game of Trades actually put some stuff out there that I posted if you want to pull, that I think actually kind of exemplified what you were talking about, that it is not the inversion that has caused something. There is always a catalyst of further that has created that. So he, puts out that, or he, she, whoever's behind it, sorry, whoever is running this put out that there were several recessions that had catalysts that occurred first. You look at the invasion of Kuwait in the early 90s. You look at the tech bubble burst at the end of the .com. You look at the housing bubble burst in 2008. Now, keeping in line with a lot of their other charts, they showed the pandemic, and then of course they make predictions of what's going to happen, later. But I also appreciate that they've talked about whipsaw signals over the past 40 years, 3 whipsaw signals. We love the term whipsaw. We've talked about that before, where the yield curve uninverted only to reinvert again. Okay. And you just talked about that as well. And so as those inversions occur and go back and forth, we are currently or at least as of the time of their posting, the longest inversion since 1929. Okay. So the longer that inversion occurs, the greater potential for a more extreme pain to be felt upon whatever catalyst creates that inversion again. And we are starting to look, as you said, as a priming of a recession to occur. Now, again, there is differences between recession and stock market volatility and risk. And I think a lot of times people put these two things together, like, oh, the market's crashing, recession. Unrelated. Recession is economic negativity, slowdown in the economy. They are correlated. You do generally see that the stock market is not going to perform as well in or around a recession because of the same variables. There's no reason to assume that you're going to push up the value of stocks and companies if you think that over the next 3, 6, 12, 18, 24 months, the economic outlook looks to be more negative. What's interesting, though, in leading up into typical fashion, is that there's actually some new data showing that household allocation to stocks recently just hit an all-time high of 42.2%. That is extreme complacency. This is the highest percentage that was noted on record leading back to 1952. Again, why? Because people, if you think about it, people have always felt fixed income was was a drag on portfolios. And they forget why you have allocations. You have allocations to different asset classes so that they can, hopefully provide some sort of leveling of the allocation. And this is more, modern portfolio theory type stuff, which again, isn't something we fully agree with in entirety in terms of how allocation works. But the idea historically has been you hold fixed income to temper the volatility of stocks. 2022 was a perfect indicator why for years, even regulators have been saying to stop selling fixed income as safe. Okay. Even now, I do the college planning we talk about. And one of the things I tell people is they're looking at their, whatever accounts they've used for their past income for college, which is their savings, is you need to, if you've got a child that's going to school in the next 5 years, you got to temper that down to cash. And what a lot of times I hear is, well, actually, they've moved me into a conservative portfolio. Well, what does that conservative portfolio means? It means that I've got a greater allocation, that they've moved you into a greater allocation of bonds. Well, 2022 was a perfect example, and we're still seeing the pains of this in some degree, that with these inversions and what's going on with interest rates, fixed income became the worst performing asset class in portfolios during that year. And yes, that was a catalyst to further volatility in stocks. But ultimately, with the rise of interest rates and really the volatility of interest rates, it's created risk in the fixed income market. So again, just for people that had a more conservative portfolio, that is not necessarily a very, a great move, or necessarily protected, when we are in environments like this. But on top of that, as people have looked and become, kind of a fear of missing out, what have you done for me lately mentality, we've actually seen again, and you can go out there and follow any type of blog, Twitter, fin, talking head out there. There's just this push, and I've talked about this before. Just you should put everything in the S&P 500, and that's going to be your future. You can't beat the markets. You might as well just participate in them. Anything in that. They're starting to see more and more of Gen Z has actually been allocating heavily to bonds, and there's some concern there of the amount of allocation to bonds or fixed income of Gen Z. But on the other side, the complacency is actually is also pushing a greater holding into just holding, say, the S&P index fund. And a lot of people are probably outside of what their risk tolerance is. And here's the thing that's really important planning. Most people are more risk adverse than they are risk tolerant. Okay. But they don't know that because we haven't really had any risk. I mean, really, besides a blip there and there, 2018 was a little ugly. 2020 was a little ugly. 2015 had a moment. We haven't had risk. Kirk talks about this a lot. We've had volatility. We haven't had anything significantly really happen since 2008, 2009. And because of that, and risk is the fundamental loss of capital. It's not being able to get it back. And that can be lost by the capital disappearing. Like Woolworths. Woolworths is a terrible investment as of today. Circuit City was a terrible investment. Obviously, they weren't at one point, but eventually people lost everything in it as they became worthless. But risk is also the loss of time. You cannot make up 2000 to 2013 when the market was negative and the S&P 500 lost money for 13 straight years. It was negative. You can't make that up. The only way to make up those 13 years is to go back, because people like to talk averages. You can average this rate of return. Well, that doesn't mean anything in the reality of application. If maybe the S&P 500 does average a 7, 6, 7, 8% rate of return, but during those 13 years, it was negative. And so your averages are going to be absolutely different during that period, unless you can go back and put all the money into it you would have and go back and apply all the growth you could have gotten. So yeah, just getting back to present or being positive again isn't necessarily, is great. It's good to get back. But if you just get positive after 13 years, you really have to, in order to truly retain that or make up for that loss, you got to go back and put all the money that would have been there and where you should have been based on your averages to that point, which again would be well ahead of just getting back to break even. So we've got this interesting duality going on. We've got a certain segment that's really overly conservative investing in bonds, probably at too young of an age. maybe feeling that it's going to be safe, or maybe they're chasing that current yield because that's what they're doing right now, saying, look, I can get an easy 5% or 6% in bonds. All of a sudden you have some interest rate policy come down, you have this inversion, reinversion, and all of a sudden they lose money. Okay. That is a real threat. Ultimately, and I took my CFP, and the gentleman that sold, that taught the CFP prep course, the final kind of prep course before I took the major exam, he was a bond trader in 1987. And he said to me, and to the entire class, greatest day on earth. Of course, for him, right? For everybody else, it was Black Tuesday. It was a disaster, right? So ultimately, or Black Monday. I'm trying to remember. Monday was the Great Recession. Tuesday was was 87. But ultimately, for him, it was great. But bonds, and again, they can be very volatile depending on certain aspects. Also, we're starting to see an erosion of confidence. Okay, so they just did a survey recently. Do you think that the American dream, if you were to work hard and get ahead, holds true? And back in 2012, roughly about over 50% of people that were surveyed, and this is the Wall Street Journal NORC survey, 1,500 adults, and it was conducted between late June and early July. Over 50% in 2012 said yes, holds true. Around 40% said once held true, but not anymore, and almost zero, like less than 5% said never held true. We have now seen in that same survey conducted that under 50% of people now feel that, just about 50% now feel once, but not anymore. Those that believe it still holds true has dropped to about 35% from over 50. That's a significant shift. And the number of people that believe it never held true is just under 20% now. So in around 10 years, even though we've had the greatest, arguably the greatest bull market in history, even though economically they're talking about all this money that's out there that's flush, you see all the homes people are buying, you see all of the stocks that people hold, you see on TikTok and Twitter and wherever social media, everybody's flush with cash. The reality is that confidence is eroded significantly of the people out there that have it. And we're also starting to see, again, continued data that shows that credit card defaults from small lenders are hitting record highs. This is surpassing even the dot-com bubble and the financial crisis peaks. So consumers are starting to have more issues. The federal government, interest expense, Social Security, and health are sent to account for 87% of U.S. government spending over the next 10 years. 87%. That's 13% left to go to anything else. Estimated to grow in government spending from $6.8 trillion in 2024 to $10.3 trillion in 2034. And we're also starting to see a continuation of unrealized assets. Again, if we start to we talk about catalysts, right? We've been talking for a year or two about what's going on in the banking sector and these unrealized losses in securities, investment securities that are out there, and we've kind of just ignored it because, as I've said before in previous podcasts with Kirk, and I know I'm all over the place for Kirk today. He's like, I can't even keep up on the charts.
At least I found him this week, Doug. Last week I couldn't find him.
This is some really interesting data, but we talked before about how it was a problem, and then we saw Silicon Valley Bank go down, and the rise of digital banking. We've talked about this as well. We talked about this a couple of days ago on another podcast. The rise of digital banking, the lack of customer service, the ability to just move money in and out digitally. But then what happened? We had this catalyst. All of a sudden, people wanted to get their money out, and they wanted to get it out right now. And these banks invested in these bonds that, again, due to the interest rate increases, caused the value of these bonds to completely implode. But they haven't sold them yet, so they're still sitting on the books. But what happens when these banks get a run on? Oh my gosh, they're going to have to come up with the liquidity. Well, the government tempered this. They pushed it under the rug. They basically said, look, how about this? We'll lend you money to help you with liquidity. Oh, well, that's great. Because now the banks didn't have to sell anything to come up with that liquidity. But that ended. It ended the middle of this year. We haven't had another catalyst yet. But eventually, at some point, there's going to be a need to get liquidity out of these banks. And we are still sitting on massive, we're talking billions of dollars, hundreds of billions of dollars of unrealized losses. In other words, if those banks have to liquidate right now and come up with cash, they can't. They do not have access to the ability to come up with that cash without selling more, or unless the government steps up again and starts to raise that capital. But if credit cards are tapping out, if people are starting to get more pressed, companies start to get more pressed, then all of a sudden they're going to demand more from those banks than the banks may be able to produce without dipping into those unrealized gains, without the government stepping up. That could still be our catalyst. We don't know. Okay. At the same time, food prices just reached another all-time high in July. For the last decade, food prices at home and away are now at 30% and 51% respectively. Since 2020, food price of homes have increased 22% and away are up 27%. Okay, so food CPI. We can't stop eating, folks. I know the fasting movement is really gaining a lot of traction. By the way, if you're on the fasting movement, they've come actually out with some data to say that there's been heart attack increases on this. So be careful what you're seeing and reading on the internet and trends you're following. But if it's for you, you can only fast so long before you got to get food again. And it's expensive.
Unless of course food's too expensive, Doug, and you can't eat because you can't afford to buy the food because of inflation.
That's
Which case
right.
is forced fasting.
Forced fasting is totally
you can call it fasting. You say, "Oh, I'm fasting today." It really means I don't have enough money to buy food.
Well, and then on the other hand, Kirk, that also leads to heart attacks because of stress, right?
Yeah,
So,
I think that's probably
no
more
matter what, there may be an increase in heart attacks based on forced fasting or choice fasting. And now you've got interest rate expense. Okay, I talked about the federal government, their expenditures. The interest rate expense now is increasing at it is now a record $3 billion per day. That's 3 times what it was 10 years ago. It's twice what it was just 2.5 years ago. So do the math on that. It took 10 years to go up 3 times, but only 2.5 to go up double. So that means the first third of it took 7.5 years. We are blowing up. The annual interest cost of federal debt has reached a whopping $1.1 trillion in Q2. Okay. There's very little they can do about that. And the last thing I want to talk before I give a breather here and give it back to Kirk is I want to talk a little bit about something that's fairly boring probably to most people, but it is kind of a catalyst in all of this stuff, or not a catalyst, but it's a piece of all of this that we've talked about, which is M2 money supply. Okay. M2 money supply, I've spoken about this a couple of times. It's the amount of all the money that's out there in circulation. Okay, and M2 money supply went through the roof after 2020. Why is that? Government was giving money left and right for PPP and other types of COVID-related federal loans that they then, of course, wrote off. And when they wrote that money off, that money then, of course, just stayed in the supply, and it ended up in a number of different places. Okay. So there's a gentleman who's an economist for First Trust out there, who writes some really good stuff. But he actually put something out today very interesting. We are starting to see M2 money supply go up again, which is really, really interesting to think about, because where's it coming from? It's not like the government's just giving this money out now. Now, some of that could be, again, people taking profits. We've seen some sales. Maybe they're putting money into savings, et cetera. But his point, and again, this is on one degree, is the Federal Reserve is supposed to be an independent government agency. However, the U.S. Treasury has now become a big player in that monetary policy. There's virtually very little discussion of this in the main media. For decades, the Treasury held roughly $5 billion in Treasury general account at the Fed. That's the Treasury's checking account at the Fed, generally used as a cash flow device. And I'm telling you what Brian Wesbury said verbatim. Okay, so this is coming from him. Now it has become a slush fund with roughly $800 billion held in it. The TGA, the Treasury general account, does not count in the M2 money supply. So it's not actually listed there. If the Treasury taxes or borrows, it can withdraw from M2 and hold in the TGA. So they can pull money out of the M2 and that's where M2 supply goes down. The Treasury can now tighten monetary policy by just putting money in the TGA. So once they pull it out, it's no longer counted. As an aside, This goes into some philosophies of modern monetary theory. I'm not going to get into this, and kind of those that believe that there's people behind this that are trying to push towards this theory. Now, building the TGA to a high level is one reason M2 money supply, in his opinion, contracted. So in other words, why was M2 money supply contracting? A lot of this was like, hey, the money's coming out of there, and people look around and go, people are still spending, people are still buying. Where's that money coming from? Maybe there was more M2 money supply still in the system of the people that were buyers than it looked like, because potentially money was moving to this treasury account and therefore making it look like it was being spent down. Now, on the other hand, the Treasury, if they want to ease monetary policy, all of a sudden they could take money out of that TGA and spend it. Boom, puts it right back in the banking system, in the money supply. And because the Treasury now holds so much of that cash outside the banking system, it makes it a huge player monetary supply. And the Fed is no longer independent of the political system. If this is true, this is actually a violation of the rules around the Fed, a violation of Loper Chevron. Not going to get into that right now. You can go look it up, or whatever we're supposed to call it. Congress, ideally, and under our policy, should actually pass a law saying this is okay. The former head of the New York Fed, Bill Dudley, wrote a piece that Brian calls gaslighting, fretting that if certain individuals are elected, they'll interfere with the Fed. And the reason that Brian calls it gaslighting is that the Treasury was already doing this when Bill was the head of the New York Fed. So I think it's really important, without getting too into the weeds of these. Again, if you want to learn more about this, go look it up. But it was really important to understand that with money being in and out of the system, how much control the Federal Reserve has now on very simple moves that they can do that can have extreme rippling effects on how things play out there in terms of economy, money available, and obviously ultimately, the ability to affect monetary policy.
So, and what's interesting, I mean, the Fed, people talk about the Fed being independent. The Fed's not been independent. It's never been independent. It's always captured. Whether they capture the government or the government captured them is TBD, but it's a captured entity, even though it's supposedly independent. And so when people come out and say, well, when during COVID, when Trump wanted to tell the Fed what to do, which I think, frankly, was the right move, because the Fed was going to wait, and I think they needed to act quickly, and Trump pushed them to act quickly, and it was a better move. Whether they would have done that or not, I don't know, but that was the course of events that happened. So I think in general, the Fed is always slow to move. It tends to be to their detriment sometimes, and sometimes to our benefit, because if they move too quickly, it causes more volatility in the market. So I'm not sure there's a right or wrong way, but I will say that the Fed is not independent. You have politicians, you have big moneyed people, you have banks, all telling the Fed what to do, and the Fed telling them what to do. It is one big, good old boys club where everyone knows each other, and they're all pushing for their own benefit. I mean, let's say what it is. Touch on a few things Doug said, and a few new things before we get to wrap it up here. One of the things that's really important to note is that when we look at the interest that we're paying on government debt has gone through the roof. We all know that. Since COVID, things got really ugly, and the government has borrowed a ton of debt and continues to borrow a ton of debt. And so when you look at something like this, you see net interest paid on debt. You see Social Security, you see Medicare, and they don't even talk about the military. Where's the military in this? I don't know. But what I do know is, at the moment, I believe the military spending is similar to the interest income that we're paying on our debt. So just to be clear, the military, which a lot of people believe is way overfunded because we don't need wars all the time. We have an election coming up, and we have a bunch of wars going on, and we have a government that somehow wants wars all the time. Go figure, because there's a lot of money to be made. And so there's tons and tons of money spent on the military, and that's the stuff we know about. And then, of course, there's off book stuff that they also get funded with, which we know exists, but we don't know exactly. There's that too. But when you have interest that is similar to that and is only going to get higher, not only because we will continue to borrow money, and the next crisis will have another bailout, it'll be more money, and then on top of that, we have interest rates which are higher. So as government debt comes due, they have to pay it out at a higher rate. And I've said this before. I think Janet Yellen should have been drawn and quartered when she was running things, because we should have taken all of the long-term debt, all of the short-term debt, or shorter and midterm, and basically stuck it in long-term debt as much as possible, because rates couldn't really get any lower. I mean, hypothetically they could have, but they really weren't going to get any lower. And now rates are higher, and now now it's rolling over, and we're going to be paying a lot more interest on that debt. And the debt's going to keep going higher. That's not going to stop. And somebody asked me the other day, well, why couldn't we just stop borrowing? Wouldn't that be a good strategy? Hypothetically, yes. What's the best thing if you're a consumer and you have too much debt? Stop spending, right? And stop borrowing money, right? And paying it down. That's a great strategy for an individual. Unfortunately, the government doesn't work that way. Back in 97, I think we probably could have had a chance to rectify our situation. But since we decided basically to paper over problems with debt and printed money, it's no longer an option. So anyone who thinks that that's an option, there's a reason why it's not an option, because the numbers don't make sense. It will never happen. We would all have to collectively do what Japan did, was accept deflation, accept lower standards of living, accept lower income. Everything gets deflated. We would have to accept that as a nation. And we won't. That's in Japan. That's their culture. They're willing to do things for the greater good. We are not. I don't think that's an acceptable solution here. Also, we have the fact that our system is based on debt. Now, if you have debt, you typically have collateral. So if I borrow money, if I go to the bank and borrow money, they say, all right, what do you have as collateral? Well, I've got this nice watch. It's worth $10,000. Okay, we'll loan you $5,000, and that watch will be collateral. Great. So if I don't pay, the bank takes my watch, right, is collateral. That is typically how banking has worked for thousands of years. Now, if you own a house, you have a mortgage, right? And the mortgage on that house is backed by the collateral of the asset, which is the real estate. So banks won't lend 120%, at least not anymore, 120% of the asset value, because if you default, they want to make sure they're getting their money back. So that's how borrowing and debt works. So we have a financial system which is based on debt. Everyone's printing money. The Fed is printing money. Everyone's lending. Everyone's borrowing. And so we have this system built on debt. Well, what happens if asset prices decline 50%? The whole system implodes. Everyone's bankrupt. I mean, think about it. Just assume for the moment our government is a corporation. It's a close proximity, right? Say it's a corporation. Corporation has $1 trillion in assets, and the corporation has $1 trillion in debt. So it's not worth anything, right? But you have the assets offsetting the debt in this case, in this example, right? So you plug along, and the assets grow at 5% a year, and you can add debt at 5% a year, and let's say that's the metric you're doing, and you're plugging along, and that works. Let's say a recession comes along, a massive one, or for whatever reason, and your asset, the company's assets, go down 50%. Well, now you have debt worth $1 trillion, and you have assets worth $500 billion. Well, what happens? Well, in government, really nothing happens. But if that happens to your Japan, people just say, to the hell with the lender, I'm not paying. Take the asset. I'll go start fresh. Why am I paying interest on something that's not worth anything? It's actually negative money. Take the keys. Go ahead, take it. That's what happens to our whole financial system. If you have a crash and asset prices go down 50%, we are all screwed. All of us. And so I'm using this as a frame, not only to show you the seriousness of this, but also to show that Nobody benefits from this. Well, people who are prepared benefit from it, but the whole system as a whole doesn't benefit from this. So there's a lot of incentive for everyone to support asset prices going higher. So if you want to know why the stock market keeps going up, this is the reason. It's because everyone's incentivized for asset prices going up. Very few people are incentivized for asset prices going down. Now, in a normal economy, asset prices go up and down and people benefit and don't benefit, and that's how the economy works. That is a free market. We do not have a free market. We have not had one for decades. So if we don't have a free market, asset prices only go up, and it pays to borrow because who cares? Asset prices are going to keep going up, and that means the value of the debt's going to go down, inflation is going to go up, so you're all benefiting from leverage. At some point, the system blows up because it can't support that continuous debt load. Right now, we have a debt load that is too high, and they're going to keep printing money because they have to. Because if they stop printing money, the economy is going to crash, asset prices are going to go down. Oh crap, we got to print more money, which means more debt, more interest, less ability to pay it, makes the problem worse and worse. It doesn't mean they're not going to continue down this path of printing money because they have to. I don't see any other way around it. Now, you might be really smart and say, well, why don't they just let it fail? There's this quote I keep repeating. Everyone's a libertarian until it happens to you. Yeah, great. Let it fail. And then what happens? The whole system implodes. Then things like getting food in the grocery store don't work. And we're all clubbing each other in the streets to try to get enough food for our families. That is not a healthy society. That's anarchy. No one wants anarchy. Not even the libertarians want anarchy. Even the anarchists don't want anarchy. Right? It's not a healthy thing.
And
let me
Kurt,
finish this
if you
point.
don't have assets and you're an employee, right? You're like, well, I don't care, and I'll let it all tank. You're employed probably by a company. They go under, you're jobless. It all trickles down.
Right. So the point is everything is related. So we all like to think in these little vacuum tubes and these echo chambers, like everything's gonna be great if we just do this. It's not. If you sit down, pull your head out of mainstream media, pull your head out of the newsletters, just stop and think through the situation. Think through the intended consequences, the unintended consequences, what's going to happen. I can tell you I've done this. It scares the crap out of me. There is no solution to where we're going other than a big train wreck. We just don't know if it's next year or 100 years from now. It's going to happen. And it's probably going to happen slowly, and then it'll happen all at once. I don't think it's going to happen the next year. I don't care who gets elected, right? And here's another thing, just to keep something in mind as we're wrapping it up here, because I know we're at time. We have an election coming up in 2 months. Nothing you hear in the next 2 months is going to be true. Nothing. And if you think your source of information is accurate, it's not. It is election season. It is the season of lies and liars. That is how elections happen. I know it's been a while. It's been a full 4 years. But it happened 4 years ago. It happened 4 years before that. And before that, it happened 40 years ago. It happens every single time. Election season is filled with lies and liars. Both parties are doing it. The major media is doing it. Everyone you talk to is doing it. And so you have to take a step back. And when you try to formulate where your information is coming from, think for a moment, who's giving it to me and what's their incentive? If you're listening to corporate media, it's BS. All of it. And if you don't know you're being brainwashed, take a hiatus from watching the news for like 2 weeks and come back. And I guarantee you're going to see nothing new, and you're probably going to be happier for the hiatus. But what you're going to realize is what they're telling you, they're basically gaslighting you and lying to you. You might be thinking, well, yeah, but you're just saying that because you believe in the other side. No, I don't. I don't watch any mainstream media. None of it. Because it's all BS. I don't care who you like. You might like them. You know why you like them? Because they're reflecting back the thoughts that you want to hear. That's why you like them. That is human nature. I'm not saying you're wrong. Don't take me for this person who's claiming that you're stupid. You're not. You're human. I'm not saying you're wrong. I'm saying this is what's happening. Is that corporate media is reflecting back to you like an echo chamber everything you want to hear. So it's going to make you feel good, and they're going to agree with you, so you're going to agree with them. And that's how they brainwash you. So just understand, you can watch the media, you can listen to them, but it's all going to be a bunch of lies, because election season is about getting elected. It's not about the truth. The closest we have as a candidate for telling the truth was Kennedy, and he's taken himself off the ballot. And I'm not saying he was accurate either. I'm just saying that he was the closest out of the two, out of the three, to trying to speak the truth. And even he was out there making up lies too. It's just the way it works. It's been happening since the beginning of time. It's the way politics works. So just understand that you're not getting the truth. You're not getting the news. You're getting basically brainwashed. You're getting people who want your vote. And that's okay. But just understand it's happening. So if you're looking for news in the next 2 months, you're not going to get it. If you're looking for economic data, I think it was, 2 weeks ago, Doug, where they came out with the jobs numbers and said, oh, by the way, we have a revision of 900,000 jobs. Oops.
They've revised every job report going back 3 years. Every one of them's been wrong.
Yeah. Oops. What do you mean, oops? That's 10,000 jobs is an oops. Like 1 million jobs is not oops.
we told you this, and the stock market went up. Oh, geez, nothing in it for us. No personal incentive to potentially oops those numbers. Oh, now we can go ahead and tell you revise, because now might be a good time to have some stock market volatility. And always question the timing of the information you're receiving and the accuracy of that information based on that timing.
Absolutely. So the lesson here today is don't listen to nothing of what you hear and half of what you see, I think is the quote. But you just can't do it. You have to understand that this is going on, and try to put yourself in a position where you can step back and think logically. I know it's hard. It's really hard when people are brainwashing you all over the place. I get it. I've been there. I mean, this is the reason I don't get involved in politics. Every time it even comes up, I try to steer away, because it's just people's minds are polluted with this stuff for the next 2 months. And the most rational people become irrational because the major media is basically brainwashing people, and you get sucked in. And it's tough. I know I get sucked in too, and I'm not even watching the media, and I'm hearing it. So just try to keep a clear head.
That's because I send you the tweets on it.
I know.
I suck you in.
I know, but I talk to clients every day, and they're getting sucked in, and then they suck me in, and I'm like, ugh. And I'm trying to be rational. I'm trying to stand back, and I can't, because I know all the BS that's being talked about, and I know all of it, like both sides. But I hear it, I'm like, oh, I can't let this go, but I have to, and it's just hard. So just try to pull yourself out of it, make informed decisions, and move on, and don't pollute your mind with this stuff. And frankly, don't believe anything you see, even in the financial side. The markets, people think the markets are going to crash. I don't know if they're going to crash. I don't think they are. I think we'll see volatility for sure. But people say, well, if this person gets elected, the world's going to end. Yeah, they said that about the last election. Every time they say the same thing. One side's Hitler, the other side's a communist, and we're all going to die if you don't elect this other party. None of that's true, because they've said it every time and it hasn't come true. And I'm pretty sure that's going to be the case this time. I don't think much of either candidate, but one of them's probably going to get elected. I'd say there's a good chance one of them will probably get elected. And if that happens, then we've got another president, and we got 4 more years of them, and you got to deal with it. So
don't forget, Mickey Mouse gets some votes every year. This might be the year Mickey gets enough.
I'm undecided this year, Doug. I'm undecided between Superman and Mickey Mouse. I don't like what Disney's doing, so I might go with Superman this year. But
they both wear their underwear outside their pants, so it's very difficult to decide.
They're both crazy, and they're probably more sane than anybody we're else voting for. So I like that. All right, Doug, take us home here. We're running over, so take us home.
All right, I'm going to take you home in a second, but I do want to say one thing. Again, listening to those things, $25,000 being given. This is a Harris thing. $25,000 for everybody to buy a home, which would barely make a dent in the down payment. Of course, that would drive up pricing. The same time, Trump came out yesterday or the other day and said, let's start building homes on federal lands. And if we do homes on federal lands, we can drop the price of housing by half in order to make it more affordable. Well, guess what? I just want a comment to say on that. First of all, he's a real estate guy. That's not generally someone who likes to see real estate go down. Yes, it might sound good to getting more homes and affordable, but what does that do? Again, that libertarian comment you made. What does that do to all the other people that have housing if that were to come true? Don't believe anything. And listen, when you talk about borrowing and debt, I got some stuff that we'll talk about next week or in a future one that talks about how everybody's feeling, whether you have money, a millionaire status plus or less. Everybody's feeling a little less comfortable right now. But I'll tell you where it really hits people in the pockets is college. There's three types of income to pay for college. There is the past income that you have. That's what you've saved. Okay. Not most people have not saved enough to be able to use that to pay for the entire cost of college. Even millionaires generally don't have that. So then if you don't have that, you got to make the difference through current income. And that's what's left over after you spend for things. A lot of people spend a lot of things. You just mentioned it, Kirk. Well, hey, how do I stop spending? Like, we're buying lots of stuff. Even with that, most people still don't have enough to cover it. And that leads to having to borrow for college, which now you have to think about how those resources are going to affect the future when you're also using future income to subsidize the lifestyle you want and pay for those past debts. Listen, it's a real issue out there. There's trillions of dollars of college debt out there. It's affecting everybody. We've seen the impact of it. Ultimately, at the end of the day, you've got to have a plan for paying for college. If you want to make sure that you have a successful financial future, you've got to integrate retirement and college. And if you've got someone that you're working with that's not integrating those two things, it'd be easy to plan for college. Just liquidate your retirement accounts and use it. But that wouldn't be a good plan. And neither is not integrating. So if you have some questions about this, if it is a concern of you of overpaying, if you want your child to come out of college with a good degree in the shortest amount of time, the right money, and protect all of the things that you're trying to also save for besides college, you need to get the planning done. And you might have some questions, talk to us. mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com. Let us know if you have any questions.
Absolutely. Well, Doug, I always appreciate coming on the show. This is a great time to, if you have a freshman, sophomore, or junior in high school, talk to Doug. This is the time of year to do it. From pretty much August till November is the hot time. So if you want to get his time, he's busy, but I'm sure he can carve out some time for our listeners. So please contact him. I'll tell you that college is a confusopoly, and you really want to have someone guide you through it. I know that I understand this stuff a little bit, and I'm overwhelmed by it. I can't imagine somebody who's not in finance and how they deal with it. So kudos to Doug for doing that. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.